Right, everybody. Good morning and welcome to Operation Entrepreneur Business Impact Northwest celebration of military connected business owners during National Veterans Small Business Week. I am Steve Watts-Ulrich, the program director for the Region 10 Veterans Business Outreach Center. I'm a former business owner and I'm an Air Force veteran. The Region 10 Veterans Business Outreach Center provides free business coaching and training for military connected business owners in Alaska, Oregon, Idaho, and Washington. Today's webcast master of ceremonies is Amber Bittner. Amber is a former business owner, a current military spouse, and an AASBC accredited business coach for the Veterans Business Outreach Center. With that, take it away, Amber.
Thank you, Steve. So before we launch into today's keynote, we are going to hear from Steve Brown, the Alaska District Director for the U.S. Small Business Administration.
Hi, I'm Steve Brown. I'm the director of the Alaska District Office for the Small Business Administration. Today, we're pleased to help celebrate the brave men and women who've served our country. And now they return to embark on a new mission, and that's starting their own business. By assisting veterans through the transition to entrepreneurship, the SBA honors these business owners who make our Alaskan communities stronger. They make them more vibrant, and really they help keep our Alaska economy moving forward. We have almost 27,000 active service members connected to 8 military bases across our state, and we boast the highest rate of veterans per capita with over 12%. We currently have 209 veteran-owned small businesses marketing to the federal government, and over 10% of all businesses in Alaska are majority owned by veterans, which is nearly 14% higher than the national average. There is nothing small about small business. It is the fuel that runs the economic engine of America. Half of the people who work in this country own or work for a small business. And a whopping 99.9% of businesses in the United States are considered small. The mission of the SBA is to empower entrepreneurs to start, grow, and expand their businesses, and especially right now, recover. We do this by providing the tools and resources that are needed at every stage of the business life cycle. So, on behalf of everyone at the SBA's Alaska office, all of our strategic partners, and all Alaskans for that matter, we salute you and we thank you for your service, and we stand ready, willing and eager to support you in your role as business owners. Thank you very much.
Thank you, Steve, for those words of support for our military-connected small business owners. At this time, I would like to introduce Dominique Julian, Business Impact Northwest's Chief Program Officer. Take it away, Dom.
Thank you, Amber. Good morning, everyone, and welcome. Today is the fourth and last day of Operation Entrepreneur. My name is Dominique Julian. I am white with short brown hair wearing a purple sweater. I am the Chief Program Officer here at Business Impact Northwest. To all of our veterans and our military community, thank you for your service. Military entrepreneurs are a strong force in the U.S. economy. We here at Business Impact Northwest are very proud to be able to work together with our military community, providing coaching, classes, capital, and resources on how to launch it and grow your business. Again, on behalf of Business Impact Northwest, I would like to express my gratitude to all of you that have taken the time to attend Operation Entrepreneur 2021 this week. Your presence and contribution make this webinar series a remarkable success. We hope that you had the opportunity to learn and connect with our business coaches and fellow successful entrepreneurs. And there is still time to make those connections. I encourage everyone to utilize the chat box today to share their information, connect with your fellow entrepreneurs, and to follow up with the amazing VBOC team for their free one-on-one coaching, training, and classes, because I think they're great. So thank you, and I'll hand it back to you, Amber.
Thank you, Dom. We are so fortunate to have your leadership. We now get to hear from two professionals about financing, Roland Chaitan and John Sechrest. First, we will hear from Roland. Roland is a NASBITE certified global business practitioner, the Senior Vice President of Lending, Senior Loan Officer, and Director of Strategic Initiatives within Business Impact Northwest. Roland has over 25 years of financial services experience and has been the recipient of the SBA Financial Services Champion Award for our region. Roland is a prior export-import business owner as well. So with all of that being said, take it away, Roland.
Okay, the video is not looking. Oh, there we go. Okay. Hopefully you can all hear me. I'm Roland Chaiton, and I'm very pleased to be here this morning. Thank you all very much for your service and for being here as well. I just happened to notice today that, as I do every day, I have a flag that I keep in my little pen holder right here on my desk. And it reminds me every day to reflect back on what that means, what this flag means, and in the bigger picture and what it means to me. And again, thank you for your service. So today we're going to be talking about lending at Business Impact Northwest. And we'll start off by just going over some of the different types of loans that we do here, and then we will move into some of our loan products very quickly as a recap, and then get into some more specific issues about getting financing. So we cover a variety of loans. We do term loans here, average 4 to 7 years, short-term notes, revolving lines of credit. There'll be more about that shortly. We do microloans, both under the SBA microloan program and the USDA program. We do SBA guaranteed loans, including export finance and international trade loans, and we do the commercial real estate loans. In development is a Sharia compliant loan product, an I-10 loan product, and another program that's going to be coming out soon called the Veteran Collaborative. It's going to be a national program. Everybody, please watch for that. Next slide, please. So further about some of our loan products. So we have an emergency loan that we have done up to about $15,000. It's for small businesses in business a year, sometimes a little less, and just very limited collateral just what the business owns. We have microloan products that go up to $50,000. These historically are 60 to 72-month loans most of the time with a fixed interest rate range. These are used and very popular with startups and early stage ventures. It's very flexible capital, both for inventory, leasehold improvements, equipment, working capital, and debt refinance. Now, these are collateralized, but usually in the microloans, there's no collateral up to about the first $25,000. You can check back with us further about collateral requirements there. USDA has a similar program, but meant for rural areas. And we also have money from credit union sources. Next slide, please. Next slide, yes. That money goes to $350,000. We have some money from USDA program, intermediary lending program. We will use that up to maybe $250,000 in rural areas. Our direct loans can go up to $350,000, which is sort of the lower tier of SBA guaranteed loans. And we do lines of credit. Generally, these have ranged from $10,000 up to maybe $125,000. These are popular because they're for contract mobilization and to support bonding requirements. And a lot was talked about the other day in getting government contracts. So we'll be talking a bit further about some of the issues around the contract mobilization in just a few minutes. These are generally collateralized loans. But with lines of credit, you have interest-only payments, and the principal balance on those loans will be reduced periodically as funds come in. They're generally for a one-year term, annually renewable. We have loans that apply for the Washington State Department of Transportation, particularly for contractors in that program. And as I said earlier, we do SBA 7(a) guaranteed loans, and we can do the International Trade Loan and Export Express loan in that program. Next slide, please. The SBA guaranteed loans are done by lenders. The lenders generally, SBA does not lend the money directly, except in the cases of like the PPP and EIDL programs, which I'm sure you all heard about. But the SBA does provide guarantees to banks and credit unions and CDFIs. We are a CDFI, Community Development Financial Institution, one of about 1,500 around the country, and we're certified and regulated by an agency of that same name that's under the Treasury Department of the US. And we have a bit more flexibility than the banks, and we have different loan sources, obviously. So these programs, the guarantee programs, are operated through the private sector lenders, as I just mentioned. It's mainly for small businesses that are not able to obtain credit elsewhere. When you get to put a guarantee on, the purpose of the guarantee is to help mitigate lenders' commercial risk. And there's still additional qualifications that need to happen in order to obtain one of these loans. But they do help us do lending when otherwise we might not be able to. And next slide, please. So the takeaway I want to bring out here is that there are multiple loan sources and funds, and the CDFI groups have even more than maybe what's been shown here in their finance toolbox. So as a CDFI lender, we figure out which loans and sources to use to finance your project. Borrowers are not expected to know which loan fund or source is the best for their situation. Occasionally, they may be familiar with a particular program or have heard of a particular program, and they come in and ask us about that, and we're glad to discuss any of those programs to see if it's a particular fit. But oftentimes we will do the juggling of programs and decide which are the fund sources that will best suit the client's needs. Sometimes we have to use multiple funds to get a deal packaged and done. Sometimes it's having to do with a mix of federally sourced and non-federally sourced capital. So again, it is our job to figure out the best financial solution for you. Next slide, please. So here are some of the things that we look at, and this is the part I was told that's beginning to be what you all are here to hear about. So we do look at collateral. And in the collateral considerations, there's something called loan to value. And so that is the amount of the loan divided by the amount of collateral. And when we do that, we want that loan to be less than a 1.25% there. If the loan were say a $300,000 loan, and if the collateral was $100,000, you'd have a 3-to-1 or a 3.0. Again, pretty high. We're trying to get them to match. We'd really prefer that the collateral be greater than the loan itself. So these are just targets that we have. Credit score, we have a target of 650. We can adjust this based on other considerations like other guarantors, collateral amounts, etc. So sometimes it's going to be higher than that. Sometimes it will be even lower, down to 600, sometimes a bit lower. Depends a lot on what other mitigants we have in the consideration. We have a debt service coverage ratio. We're looking here at the operating income of the business divided by the value of the loan payment itself. So we want the operating income to be at least 1.15 compared to 0.1 on the loan payment amount. In that ratio, it would be better if it was 2.0 to 1 or 3.0 to 1. That's sort of our minimum and also an SBA minimum. It shows us that the operating income is sufficient to cover the loan payments. And that's what's necessary to keep everything okay with the business and not get behind with payments. The current ratio is your current assets divided by your current liabilities. Again, we're hoping that that ratio is greater than 1.0, meaning for $1 in assets, for $1 in liabilities, you have at least $1 in assets to cover that. Preferably, it's going to be higher. We'd rather see 1.25, 1.5, 2.0. So $2 in assets for every dollar in current liabilities. These are some of the targets that we're looking for. The net worth of the business is a check on your assets minus your liabilities. Generally, the current assets minus current liabilities, and that tells us what the I'm sorry, it looks like I think we have a mistake there. Well, go on, let's skip that. So the time in business, we are looking to see that the business is in business either as a startup or numbers of years. The longer the business has been in business, the better the chances are that it's going to continue and it can keep moving forward. Let's go to the next slide, please. Okay, we have a new program that we're starting out. It just launched in August, Washington State Flex Fund. This is sort of a continuation for businesses that were impacted during 2019 or 2020 by the pandemic. And it's a way that they can apply for some additional funds at a very competitive interest rate. 4% for a 60-month loan or 4.5% for a 72-month loan with a credit score of 600 or higher. The collateral is limited just to the business assets, generally what the business has in its equipment and inventory, et cetera. And it can be used for general purposes, but not for debt restructure. The loans are being done by CDFIs. There's about 6 of them in Washington State. You can apply through Washington State Flex Fund, and you can Google that for the website. I think also I'm seeing it up here, https://smallbusinessflexfund.org, and you can apply directly. You'll get matched to one of the CDFIs, and they will be able to underwrite this loan. It's a fairly quick underwriting. It will hopefully help those businesses that still didn't quite get enough with PPP and EIDL loans. Okay, next slide, please. So here's some other parts that we would like to get into that come up frequently when we're doing financing. Term loans versus lines of credit. So term loans can generally be used for a variety of purposes: equipment, inventory, working capital, leasehold improvements. Lines of credit are only for the working capital needs generally, and they're also used a lot for mitigation, mobilization of contracting. Term loans can provide permanent working capital where the working capital component is needed, but you want to come into ownership of that money instead of borrowing it and then paying it back and borrowing it and paying it back and never coming into ownership, which is what happens in a line of credit. You run it up, pay it down, run it up, pay it down. It's not generally sufficient for contracting situations where bonding companies want to see the capacity to keep drawing on a line. We do try to increase the line of credit capacity regularly for those businesses that are growing. When we're looking at term loans, generally those are going out at 4 to 6 years. Some are smaller. Line of credits are annually renewable. Again, with the opportunity to increase the amount if and when more dollars are needed. Term loans will have a monthly principal and interest payment, and that is higher than just paying the interest-only payment of a line of credit. So it's not quite as helpful for contractors needing least cost capital for project mobilization. Okay, next slide, please. So I was asked to mention some things about common barriers to lenders and some of the challenges. So for beginning entrepreneurs, oftentimes the commercial banks and lenders are not familiar with dealing with micro businesses, very small startups, early stage businesses, because they like to see businesses that have been around for a couple of years, because oftentimes these newer businesses come in with no credit history or less than ideal credit. Sometimes there's a barrier because there's little to no capital. Sometimes people have very limited personal funds invested in the business. Sometimes there's insufficient collateral for a loan, and sometimes there's lack of experience for a new venture. These are all common challenges and barriers that we see people coming up against all the time, and we use technical assistance to try and mitigate this. And by working with a CDFI group who are more flexible, we can often find ways around these challenges and make things happen. This is partly why the commercial banks refer deals to us that they can't get them done themselves, because they're faced with these challenges. And we know how to work with these and put everyone's best foot forward. Next slide, please. Now, some common barriers to lending and challenges that the contractors will encounter. So many early stage contractors are not prepared really with the critical information that a lender wants to see in connection with a line of credit request. Oftentimes they do not know the critical timelines about when they're going to be receiving payments from primes and or owners in contract situations. This frequently includes work on government contracts. We see these requests come in and we see projected financials, but the timing for when the payments are going to be coming from primes and owners just is not specified well at all. And most of the time, when we run into problems, the big problem we run into is we are getting a cash flow projection from the contractors that hasn't been prepared properly. It doesn't reflect all the aspects of the contract situation, particularly the payroll cycle. It is one of the biggest issues in contracting. You have to keep your employees paid. And so you need to be able to account for having those funds available for every payroll. So what happens is we see cash flow projections that are done for a 12-month period, but if the payroll happens twice a month, then really we need to be looking at what's going on during a 26 period cycle instead of 12 periods in a year. So that reflects like half of the year. So every every 24 months or 26, either way will work. And we need to look at those again for every 2 weeks or every half month. And so people need to go back and do a longer, more elaborate cash flow projection. Next slide, please. So just a brief refresher on cash flow, and this goes mostly for the newer startup businesses. I frequently hear people say, well, I understand what a profit and loss statement is. The income coming in, the expenses going out, and then net profit or net loss. Hopefully it's a profit, but I don't understand what the cash flow is all about. So I'm going to try and simplify this as best as possible very quickly. So everybody is doing a cash flow of sorts if they are managing their own checking account, because a checking account is a form of a cash flow. The cash flow has a starting cash position. It has money coming in. So in your checking account, that would be any deposits you're making over the month. And then it's got money coming out. So it's going to be any expenses you've got going out during the month. And then at the end of the month, you have your ending cash. And that becomes the starting cash of the next month. Well, when you're doing a checking account, you are taking money in at various times during the month. And in between those times that the money is coming in, you have money going out. And so it's not all at once looking at the money in and the money out part. And when we do a cash flow for business, that's the difference that we're making. We're taking our starting cash, whatever is available at the beginning of a month, and then we're just grouping together all those deposits, all that income that happens during the first part, which we call the money in part of the cash flow cycle. We add those together with the starting cash, and that tells us all the cash that would have been available in the month for handling expenses. Then we look at all the money that goes out in the month. And if the money that has come in is greater than the money that has gone out, obviously you'll have a positive ending cash position at the end of the month, which will be the start of the next month. So in projections, what we are doing is we are actually charting the flow of that money, just like that, with additional pieces about the money that has come in, the sources of the money, whether it's from revenue, whether it's from lending, whether it's from equity investments, or the expense part, whether it's buying assets, whether it's paying for operations, whether it is paying debt service. And so we just keep adding some line items in there. But this is based on this very simple pattern that's shown right here. Next slide, please. And again, on the cash flow, you are all doing it if you are running a checking account. So don't let that scare you away. Everybody can do this. Some other common barriers that we have with the contractors, and I already mentioned about tying the cash flow to the payroll cycle. When contractors come in and they request line of credit levels, sometimes the requests are incorrect because the project mobilization costs that really need to come to the front of these requests need to cover just past the point where the contract progress payments start being received. So if you know you're going to be paid in 90 days or 120 days, you need to be able to cover your mobilization costs up to that point. But you don't need to ask for mobilization funds for the entire year. So sometimes people come in and ask for an entire year's worth of mobilization funding when they're just doing one project, and we can get this done with a much smaller amount, which they could qualify for. But when they ask for so much money up to the entire year, sometimes they just can't qualify for that amount. So that's another one of these challenges we have to work through. The other one is about having too many projects happening at the same time, particularly when the first 2 or 3 months of the projects overlap. So when you have this happening, it's oftentimes a result of poor planning or more so just over committing, because you have too many demands for mobilization all at one time, and it takes the lending requirements beyond what you might be able to do. So again, this is where working with technical assistance can help space things out, and you can also do a cash flow projection to see when these problems will come up so that you can avoid them or find workarounds. Next slide, please. So here's an additional loan ratio consideration that I purposely left off earlier because it's the lead into our next speaker. So one of the things we do look at is the debt to equity on a project, overall for the business. How much debt does the business have, meaning their total liabilities, compared to the equity that they have on their balance sheet. So banks often say it can't be greater than 3 to 1. So $3 of debt for every $1 in assets or equity on the balance sheet. Our maximum has gone up as high as 5 to 1. The reason these ratios even exist is because it's been shown over time that businesses that have too high of debt to equity ratios just don't survive. They can't ever recover from having too much debt and having too much debt service going on. Sometimes we can mitigate it and keep this very high, or maybe even go above our maximum by bringing in some additional guarantors or additional collateral. But most of the time we try to keep it within that 5 to 1 ratio. So here's what happens, an example of a very typical challenge we will see. Suppose a borrower has $40,000 equity on their balance sheet, and they have maybe $20,000 in cash in the business right now for a project, and they need $320,000 for the total project. If their debt to equity maximum is 5 to 1, then the most they would be able to borrow here would be $200,000 as debt compared to the 40,000 in equity. That's the 5 to 1 maximum. So if the project was 320,000 and they only have 220,000, they're still going to be short $100,000. And now they can't borrow anymore because they're up against the debt to equity ratio maximum. So where might that remaining $100,000 come from? And that's going to be the topic from our next presenter, who will be discussing equity. Thank you very much.
Thank you, Roland, for that very informative presentation. We really do appreciate the knowledge and experience that you bring to the table. But now we will hear from John Sechrest. John is the founder of the Seattle Angel Conference, is a global facilitator for Startup Weekend, and is the co-organizer of the Lean Startup Seattle. John eloquently and accurately describes himself as an entrepreneurial collaborator. I focus on entrepreneurial and innovation efforts as a way to develop new projects and companies. My efforts are focused on building the tools, skills, and processes that enable people to make a positive impact on the world. All of the changes we are seeing in the world will find lasting and sustainable solutions by entrepreneurs and innovators, creating new pathways to solving complex issues. By connecting resources, people, and projects together and building feedback mechanisms into the conversation, I make significant impacts on the groups that I work with. I continue my efforts to impact the startup climate in the Northwest. So with that being said, take it away, John.
Cool, thank you so very much. Can we go to the next slide, please? So my biggest effort is the Seattle Angel Conference. That is a program for teaching people how to do angel investing. About 10% of our population is capable of doing an angel investment by law, and I'll get to the details of that. And I'm now about to do the 20th Angel Conference on November 17th. And so we will go through what does it mean to do that. And we essentially invest $20,000 each cycle into some startup, and we'll go forward with that. Next slide, please. So there's a lot of different ways that you can get alternative sources of money. If you're an early stage company, that early stage company might not be able to get anything from the angel, from a bank because they're too early. And so it may be the case that they want to look at some form of selling equity. But there are other things besides selling equity, and there's all of these different paths, and each of them has different constraints, and they also have the opportunity to cost you different amounts. And so you should pay attention to that. We have people that use their home as a way of getting a loan to fund their business. We have people that sell their car. We have a lot of different pathways, one of which is to sell a piece of your business. And so we'll see what that looks like. So the loan ratio that Roland was just talking about sort of puts a box around how much you can get from a bank or from a CDFI. And so if you're going to sell equity, a piece of your business, what can you do about that? The process of selling equity to other people is a regulated activity, which means that there's rules with the federal government about how you can do that. And specifically, there's the Securities and Exchange Commission, which does define all this in Reg D. So Reg D, 506B, 506C are typically angel investors. There are other pathways, and there's a total of about 12 of them, but these are the 5 that I think you mostly need to know about. Rule 504 is an intrastate pathway, which allows you to raise money from anyone in the state, not just accredited investors, but they have to be inside the state of Washington. And the program is called the SCORE program, which is distinctly different than the SCORE program, which is an advisory program. And then there's this regulation CF, which provides for federal crowdfunding. And crowdfunding in the sense of selling equity in your business, not selling t-shirts or selling pre-orders of your product. 94% of angel investors are doing Reg D 506B, which is a private solicitation, which means you can't go on television and say, hey, I'm looking for angel investors, please invest in me. Reg D 506C, with different edges, allows you to go on the radio or on television and say, hey, we got a great idea. Angels invest in us. And so there's rules. And if you don't follow the rules, you can mess up the story significantly. So what does it mean to be an accredited investor? They define $1 million, not counting your house, in net worth makes you accredited, or 200,000 in income in the last 2 years and probably the next year, or 300,000 income with your spouse in the last 2 years, probably next year. So Facebook employees, median income is 240,000. So we know that more than half of Facebook employees are accredited by federal law. I have exactly one person in the last 10 years who has worked at Facebook who's ever invested. So that means there's thousands more Facebook employees that could be writing checks and they don't. And so my job is to try to convince them to write checks. Presumably your job is to be interesting and fundable. And so I also help with that process. So the angel conference process that we do is we take $5,000 from each of 40 people. We create an SPV, a special purpose vehicle, to put all that money in, and we write a $200,000 check, hopefully in exchange for 10% of your company, sometimes at 5% of your company. And you give us stock in your company at some level. And there are a bunch of different ways to structure that, which leads to the valuation question. What's the value of your company? And if you don't currently have sales, or you have small but growing sales, we might end up having an argument about what the valuation means. And for the most part, angels, investors, accredited investors, are investing in C Corps. And they don't want an LLC, which is they don't want to be surprised by the pass-through features of an LLC. They want to have a C corporation where it isolates the revenue from the investor. And The key thing is you're setting up expectations that you're paying the investors back. And so if you take the 200,000 and then you grow your company from $2 million to $20 million, then you sell the company and you pay us back 10% of the $20 million. We like that. That's a good deal for us, but also means you had to sell your company. And if you're not planning to sell your company, then selling equity is probably not the right answer, unless you consider another mechanism to get people out. And let me just mention that there is a revenue-based financing mechanism that can get you through that. But maybe that's a different conversation. We have some conversations about that on our YouTube channel that go into that detail. So we are either looking for a company that's growing big, it's going to go get 10 times bigger or 100 times bigger relatively quickly, and they want to go fast. And the reason they're taking the outside money is to go fast. Or we're looking at companies that have significant margin, and so they can pay us back a percentage of revenue along the way. And so one of those two things. So if you're not growing fast and you have no margin, then outside equity investment is probably not for you. And you're going to have to look at one of the other pathways. That question of how you pay back the investors sets you up for a bunch of important conversations and ends up changing control of the company. It ends up changing the direction of the company. And so you need to be clear on that from the beginning, because it will change your experience dramatically for what we're doing. So I think the best place for you to get revenue is from your customers. And sometimes your customers will pay you to solve their problem before you built the solution. And that's like Tesla and his Tesla 3. He sold 500,000 Tesla 3s before he had a factory that would produce them. Everybody said, I want one, here's my $1,000. So 500,000 times $1,000 is a serious amount of money, which then allowed him to go get bank loans, which then allowed him to build the factory, and away he went. And everybody just had to wait 2 years to get their car. That's a reasonable pathway, and equity crowdfunding can be the same. You can go to strategic partners, or you can go to customers and get them to buy a piece of your business, or you can do like Kickstarter, Indiegogo, and sell products, right? So two different things: sell the equity in the company, pre-sell products, or sell other services. Crowdfunding is a way to do that. And this kind of thing that I'm talking about really works best with business to consumer, not so well with business to business kinds of businesses. But you should think clearly, do I want to give my strategic customers or my strategic vendors the ability to vote on the direction of my company? Because when I give them equity, I also give them votes in the behavior of the business. And so you give up control. If you give up 50, 60% of the stock in your company, you then don't have control of the company. Whoever has the 60% of the company has control of the company. So when you start going through this, you definitely need to have a lawyer. And so be clear about what SEC exemption you're using. And you definitely need to have a clear understanding of that cash flow projection, the cash flow pro forma that Roland was talking about. And you probably need a chief financial officer, at least a fractional chief financial officer, to do the 5-year projection of how you think this business is going to go, and to do it at a sufficient detail that you tell a meaningful story to the investors so that they can lean into that process. You don't always have to eat the whole elephant at once. You don't have to buy the $5 million investment. You can do the food truck instead of the restaurant. You can do the food cart, or even you can do the one weekend Saturday market booth. Prove that that works, get the cash flow positive with that, and then work your way up and not try to do everything all at once. And so you might find that more valuable to you to start small and work your way up. When we look at angel investments, we're expecting to be able to answer all of these little red squares. We want to understand what kind of customer you have, what's the submarket that you're clear about, what's the pain that they're having that they're in need of resolving, how many people have this problem. And when we're talking about growth companies, we're talking about big markets with billions of dollars in them. We're trying to categorize our product and our name and set up the value proposition that differentiates you from the rest of the products in that space. We know that at the early stages, when there's not a lot of revenue, that it's the team that's going to make a lot of difference. And so if you're two engineers in a garage with a dog and an idea, maybe that's not a credible team. And you probably need a marketing person and you need a financial person in there somewhere to work on that same thing. There are 15 ways to make revenue. I encourage you to get the Trajectory book by Dave Parker to dive into that business model thing. And then you try and frame, what this thing, we're the Airbnb of workspaces or whatever it is that you do, so that we can get into our head what it is that we're talking about in enough focus that we can position it against the other things that we're hearing. And our goal when we give you money is that it changes the efficiency of your business. Not it gives you more time to do what you're already doing. It doubles or triples the productivity per employee of your current process. And so you need to tell me about what the milestones you have hit, what the milestones you plan to hit are. And then, always when you're doing these things, have a request of why you want me to do something along the way. If you don't have clarity on those, you need to get clarity on all of those before you talk to outside investors. And I think that's even true for people who are loaning you money. So the Seattle Angel Conference is happening November 17th, and we'll start the next one that will run March through May. We have the Alaska Angel Conference that's running. I think the deadline's coming up soon for that. And San Diego has an angel conference. I think the deadline for San Diego is on December 1st. We have 8 other angel groups in Seattle. In January, we'll have a workshop that is inviting all of them to the workshop so you can meet all of them. But for the most part, that activity doesn't happen for 99% of the companies. You're not doing angel investing. And so then maybe in the process of seeing if you can do angel investing, you'll discover the other thing you need to do. The Department of Financial Institutions for the state has a nice decision tree around how, which choice you should use. It's a little bit old, but it's worth thinking about. And they have a whole, here's all the options for your intrastate investing, which I think is probably for very early small businesses that are not planning to be billion-dollar businesses. It's a pretty good overview, and it's worth going through and understanding those things. At the core of being fundable, you need to have your fundamental business anchors in place. And so in order to do that, these 4 books, I think, will help you get there. Running Lean helps you with the Lean Canvas. Lean Customer Development by Cindy Alvarez helps you do customer discovery in a meaningful way. The Startup Owner's Manual has a lot of appendices that are really quite useful. And then the Angel Investing book by David Rose will help you really understand why and how angel investors need to think to be successful at angel investing. And you need to tell them a story that will make them successful at angel investing. So thank you. If you want to come, here's the ticket. And there is the YouTube channel for our stuff, which will allow you to see our past 2 years worth of workshops. There's a particularly good one about 3 weeks ago on financial modeling that I think everyone should do. It's a world-class workshop. I definitely encourage everyone to go look at that. Thank you.
Thank you, John and Roland, for your very informative presentations. We are now going to open up for some brief Q&A. So please feel free to post your questions in the question box, and we will do our best to answer as many questions as possible live. And then we will send out a follow-on email with any remaining questions along with answers during the week of November the 8th.
So Shawn asked about the ticket. Now, yeah, I'll post it in. Any other questions?
And I am currently seeing no open questions within the chat box.
That tells me that Roland and John did a fantastic job. That's what it tells me.
Absolutely.
Awesome. Oh,
So there's a gap between what Roland and I do. He is still focused on term loans as a core mechanism, and I'm focused on equity as a core mechanism. And in between that is this form called revenue-based loans. And we're starting our revenue-based finance. And there's a book by Looney Libs called revenue-based financing. And so that book, he uses that for his accelerator, Fledge.co. And he's made over 65, 70 investments into startups where he ends up investing, I think it's an equivalent of $30,000, $40,000 into the company. And then he goes through and takes 4% of revenue over the next 5, 10 years that pays back that money multiple times over, maybe 3 times over. And then the equity is out of the business and the investor's out of the business, and then you can keep going with the business. And what that revenue-based financing does, it allows you when you're not making money to not have any payments, but when you're making a lot of money to buy back more and more of the equity that you might not have had access to. And so it allows you to adjust your payments based on the success of the business, which I believe is a very useful pattern. There's only one company that I know of that is succeeding at that right now, which is Lighter Capital. And they only focus on SaaS companies, and they want to write you $1 million check. So it's probably not for this group. But having systems set up that are like that, I think would be very useful for us to put things in between the gap between what Roland does with a term loan and what I do with an equity investment.
John, can I just add to that to say that as part of our development of the Sharia compliant loan, we're also looking at something that is similar to that model. So stay tuned, because we may be moving into that arena in the future, just what you're talking about now. Also, I'll mention to everyone to just check the chat. I've corrected the ratio item that came up wrong on the slides before. That should have been working capital is your current assets minus your current liabilities. That tells you what is going to be available for the year. And we look at that number to know if that's going to be enough for the operation of the business throughout the year. And if not, that might be cause for an increase either in the line of credit or additional term loan financing. Thank you.
Steve, do we have time for one question that just hit the chat, or do we need to break now?
Let's take the question and we'll shorten our break so we're back at 12:36 Pacific time. How's that sound?
Perfect. So we actually have a question here in the chat. It says, if you plan on starting small, but eventually want to be a corporation and have more funding options, should you start as an LLC and can transition later, or is it better to start just straight out as a corporation?
So my belief is that if you plan on taking outside money where you're going to sell equity, that you really want to just start as a C Corp. It's going to simplify a bunch of things, and you're not going to have a lot of additional expenses. It'll cost you thousands of dollars to convert from an LLC to a C Corp. You can do it, but it's an extra expense for not really a lot of benefit. And so I think that the answer is, if you ever intend to take an outside investment in equity, then just do the C Corp. It can be done quickly and easily, and you need to get in the rhythm of having a board and having the habits that a C Corp forces you to have anyway. It's relatively easy and straightforward. And the CPAs that talk to you about the tax benefits and so forth really are not paying attention at a deep enough level to the fact that in the beginning, you're not making a lot of money. So there's not a lot of tax benefits anyway. And so the tax benefits in the C Corp will accrue to the C Corp, but they won't be a lot. So just do that. Now, the one place where I would suggest differently is when you don't know what kind of business you're creating, and you're basically going to have an experiment place where you're running experiments. I'm going to try a dog thing. I'm going to try a cat thing. I'm going to try a horse thing. And you're setting up these experiments, which you might then spin out as C Corps, but which you then intend to continue experimenting with the other ones. Then you can set up an LLC as sort of an R&D entity to manage the money for your experiments. And then once you figure out what you're actually going to do, then you should be able to form a C Corp around that and then move quickly to do that well. So there are companies that have done that where they set up the LLC really quickly. It's cheap and easy. And then when they figured out what the real business was, they set up a C Corp for that. I think that's a very meaningful pathway.
I'll just add to that this year we had 2 different LLCs that changed into becoming C Corps. And as John was saying, there is additional legal expense there. It was like a minimum of $2,000 right away that they had just to deal with paperwork to get that changed over. In one case, I think it was considerably more. So if you know you're going to be raising additional capital and you need that C Corp format, by all means, try to start with that. I agree with John on this one.
And to be careful about the fact that when you do that conversion, there's a bunch of detailed records you need to have. So you might have considerable amounts of staff time getting your records all reorganized in a way that's useful. So it can quickly end up being $20,000, $30,000 if you've been a little bit sloppy with your data collection about your business.
Hey, thank you guys so much for that. But let's take a short break. When we return, we will be hearing from our 2 spotlight businesses of the day. And Steve, you said to be back at 12:36?
That is correct, 12:36.
Okay, so
I like random times.
12:36. Yep. Okay, welcome back from break. I would like to introduce our two spotlight businesses of the day. International Business Associates, represented by Curt Maier. First, International Business Associates, commonly known as IBA, is a full-service business brokerage firm. We professionally sell privately held companies and family-owned businesses employing best practices in environments of strict confidentiality. IBA provides business buyers with quality companies at fair values to evaluate for potential acquisition. Curt, please take a minute or two and tell us about yourself and your business.
Sure, thank you. Hopefully my video will start here. Let's see. Needs to be activated. Not sure why it's not showing, but I will introduce myself. So Curt Maier, I am a veteran, United States Navy. I've had the pleasure of 3 careers. The first was the military career in nuclear submarines. The second was in Fortune 300 company in the chemical industry. And finally, the last 18 years as an entrepreneur, which is the reason why I'm here. IBA is a merger and acquisition business brokerage firm. We primarily work with sellers. So these would be the owners of privately held or family-owned businesses in manufacturing, services, or retail. And these businesses typically would have a value from as low as about $1 million up to $25 million. So the lower part of the middle market, the upper part of Main Street businesses. What we also do is work with buyers, and that's where the veterans come in, because whether you're a transitioning veteran or a veteran that has been working for many years, entrepreneurship should be something that you consider. I mean, it's the whole essence of Operation Entrepreneur. And in my mind, there are 3 alternatives that you have from starting something from scratch, either buying an existing business, or purchasing a new franchise where you're starting from scratch, but of course you have the support of a franchisor, which increases the probability of success. So again, IBA works primarily with sellers of businesses, but we do work with the buyers. And when veterans come to us, we assist them in all aspects of support, from helping them with funding, which we're talking about here today, to aligning them with the right transaction attorney and the right CPA to complete pro formas and such to satisfy the needs of lending sources and such.
Thank you, Curt. Now we will hear from Shawn Palmer, U.S. Navy veteran and founder of the Leadership Coalition. The Leadership Coalition provides on-site customizable team building and leadership development, plus workplace reintegration workshops for growth. Shawn is participating today because, in his words, service comes full circle. To be able to stand shoulder to shoulder again with my brothers and sisters in arms and share this area of expertise. Shawn, please take a minute or two to describe yourself and give us an overview of your business.
Amber, I appreciate you. Good to see you again. Leveling up is a term that's become a little bit more common in business nowadays, and the tools to level up, we in the military were already familiar with. We call those force multipliers. And it starts with things like nutrition and fitness, and a force multiplier is, rather than put one more component into the battle space, it's about maximizing productivity and efficiency for each of those individual components. And the Leadership Coalition is rooted in those core tenets of leadership that create force multipliers for you, your team, and your organization. So whether you ambition to reintegrate your workforce back into your physical workspace, whether you want to grow from 2 locations to 4, or if you're just trying to get your leadership pipeline established so that your organization is better suited or best suited or positioned to really take that next phase in your growth, we are your force multiplier.
Awesome. Thank you, Shawn. So now we're going to launch into our panel discussion. And the first question, and Shawn, since you're on camera and unmuted, what is your favorite part of being a small business owner?
The Japanese have a term. It's called ikigai, I-K-I-G-A-I, and it translates to the purpose. And if you can imagine a Venn diagram that's got 4 circles and that middle point where all 4 overlap, where you've got something that you're good at, something that you can be paid for, something that the world needs, and something with which you hold a passion. When you're an entrepreneur, you have an opportunity to operate in that little itty bitty section, and it doesn't guarantee you anything, but it is just a fabulous place to be able to start, and really a great place to be. And that's why I like being an entrepreneur.
Awesome. So what about you, Curt? What is your favorite part of being a small business owner?
Well, I love Shawn's description there, and I'm going to use a different model that I think many people are familiar with from Philosophy 101, and that would harken back to Maslow's hierarchy of needs. I think the best thing about being a business owner is that it allows you to reach the top of that pyramid, which is above self-fulfillment. It's transcendence. It's this feeling that you've made it, and that it's time to give back. So you're just totally at the highest peak of joy. You're leading the show. You're not taking direction from anyone. And I contrast that with my 20 years in a corporate environment. I can assure you the last 18 years as an entrepreneur has been a lot more satisfying as a small business owner versus a middle-level manager.
Awesome. Okay, so going back to Shawn, what challenges do you see for small business owners who are trying to access capital?
I see fundamentally just a lack of understanding. And we had today's keynotes for a reason. Roland and John sharing some great knowledge and a great knowledge base on both the debt and the equity side of things. So one, the understanding that it's out there. It may not be a traditional loan. It, in all likelihood, will not be a grant, but there are ways to fund your business, either your growth or your startup. And then the understanding of how the complexities of your component financing fit together. If you've looked at your TSP or your IRA statement and you see that pie chart, that asset allocation for your investments, you can have a funding allocation as well. And that both mitigates risk and helps align the funding source to what you're funding. Long-term funding for capital improvements and short-term debt for things like inventory control and things that we're typically not reversing. We're not going to put long-term capital build out on a business credit card. Likewise, we're not going to take out a long-term loan just to cover 90 days worth of inventory. So just that level of understanding. And I'm going to, while Curt's talking, I'm going to drop a link to a webinar on that exact thing into the chat, should you guys want to go and take a look.
Thank you, Shawn. Okay, Curt, so what challenges do you see for small business owners who are trying to access capital?
Well, I think the challenge that they have is to realize that there are many more options out there to consider than they're aware of. I mean, you have to be creative in terms of thinking about the assets that you have that you wouldn't normally be thinking of leveraging. So, for example, I'm not sure if folks are aware that you do have the ability to borrow on your 401k if you have built up some funds in your 401k for the purchase of a business. And you do that by establishing a C Corp. And what's unique about that is that you're able to leverage those funds and be able to grow a business over time. And, hopefully if you're building your own business, you're controlling things. And hopefully it's going to be more profitable to you than however it was being managed in that 401k plan by Fidelity or another fund. Those might net something like 6 to 8% in the long term, whereas a business return, will be double or triple that, albeit with a risk. So, the challenges are really the fact that you just don't have collateral. If you're a startup, you can't point at any kind of cash flow, it's all projected. And I think it was very well covered by the previous speakers in terms of, the SBA loan and the need to raise equity in angel environments.
Okay. So Shawn, how has your military experience been an advantage for you as a business owner?
Big advantage, little disadvantage. The big advantage comes from just the tenacity of mission focus. We in the military know that we will continue to apply resources until we can get that box checked. And as an entrepreneur, that is so incredibly vital. When in the early going, when the financial incentive isn't there, spoiler alert, oftentimes it's not. It's that tenacity and that passion that's going to keep that young business owner opening the doors early, staying late, putting the shoulder down, and making a go of it. So that tenacity to always push forward and know that with enough effort, yes, there is going to be some sort of breakthrough through these fun challenges of entrepreneurship. The downside to that, and it's slight, but it does exist, is that sometimes we can get so mission focused as an entrepreneur, we miss out on being profit focused. And I really feel that's where a business owner needs to operate. So keep the tenacity, but do make that shift, that pivot to focus on being sustainably profitable.
Absolutely. So what about you, Curt? How has your military experience been an advantage for you as a business owner?
Oh, immeasurably. As a nuclear submarine officer, I was taught early on as far as attention to detail, ensuring that there were no surprises and being able to execute a process. So what my military career created was an executor. Basically be given an order, be given a process and execute it. And I think I've carried that out throughout my career. I think, as a corporate guy, I went to work for a company that needed executors. They had proprietary technology as barriers to entry against competitors. They had capital barriers to entry. And what they really were looking for were executors, get this done and do it efficiently and effectively. So that was very positive. And I think that, what the military creates is somebody very attractive for franchisors. Because in a franchise system, they are looking for executors. They're not looking for somebody to tweak the model. If you're going to look at a Subway, they don't want to hear about, somebody bringing tacos in or something like that. You stick to the plan and you execute the plan. So, Shawn was trying to think of some negatives, and I'm like him. I think it's hard to think of anything negative that my military background created. I would say that I was less innovative as a result of, sticking in a system and such. And so if you are an innovative person as an entrepreneur, and you want to, explore things or come up with something brand new or whatever, then franchising probably isn't for you. But, if you're a first-time buyer, which most veterans are, first-time entrepreneur, the most important thing to do is be successful, right? I mean, you want to be successful with your first rodeo. After you get some experience under your belt being a small business owner, things will become easier. It'll become easier to get that SBA loan through Roland or through a bank. So you want to think about, how do I make sure that I have the highest degree of success? And so I would just encourage you to consider the purchase of something that is currently operating and that you can improve, or consider a franchise. If you do consider something from ground zero, there are other assets that you may have discussed during the week, such as Bunker Labs here, that supports military for startups and such. And then you're really going to have to lean on what Mr. Sechrest talked about as far as, raising some equity, because those are, startups and pretty risky, and it's going to be difficult to get funded.
Okay, absolutely. So Shawn, what, if any, changes have you made to your business due to the pandemic?
Changes a plenty. And I think that if you're a product-based business, and we hear stories about beer distributors getting bottled water to disaster areas, but aside from that, you're not doing a whole lot to actually change the product, but maybe how you deliver it to your customers. And we've seen it with curbside pickup, and we've seen it with third-party delivery services. And I'll tell you, if you came to me 5 years ago and said, hey, I'm going to pitch you this idea for Uber Eats, where someone will pay $5 to get $4 worth of fast food, I would have said, that's never going to work. But here we are. In a service-based business like I have, it's different because you can shift more easily, but you've got to absolutely be on the forefront of that curve to shift at the right time, which is almost always shifting first, and not being at the back of the pack. So changing to business advising, and then once we started getting back into the workplace, because the market for public speakers when COVID hit immediately evaporated. And a lot of things I had set up were indefinitely postponed or just straight up canceled. And so now that we're transitioning back to being in the workplace, people have to learn how to reintegrate. And so that's another service that we began offering, is those reintegration workshops to get your people up to speed.
Absolutely. Awesome, Shawn. So Curt, what about you? What, if any, changes have you made to your business due to the pandemic?
Well, interestingly, for my specific business, where we're meeting with sellers, we're meeting with buyers, really the only thing that has changed has been a shift more to virtual meetings versus face-to-face. So a lot more use of Zoom and such. We are a licensed real estate broker, so Olympia has dictated certain social distancing requirements and such, similar to what you see in restaurants and that kind of thing. But it really hasn't affected our business all that much, and we have not had to modify it as much as many businesses, as Shawn detailed so well. He gave a good some examples of how various businesses are changing during the pandemic. But for me in our particular business, it really hasn't been that traumatic, thank God.
Okay, and we are coming up on the last question, but Shawn, what piece of advice would you give to a business owner today?
There is going to be long days, long weeks. There's going to be sacrifice. There's going to be a lot of hard work that goes into it. But at the end of the day, we should still be able to enjoy what we're doing, either through a sense of accomplishment, job satisfaction, or just the confidence of knowing what you're building for you and your family. We should still, at the end of the day, be able to smile. So whatever you choose to do, have fun.
Absolutely. What about you, Curt? What piece of advice would you give to a business owner today?
Oh, Shawn sets a high bar. I mean, he really stole my thunder. I would say something similar in that, don't fear this, okay? You made the hardest decision by deciding to get into business for yourself. So don't fear things, you'll figure it out. What I like to think about is that it's really not what you know, it's who you know. And it's a trite little statement, but I'm an engineer by training. And I think of the ways to increase one's net worth. And I think that's what all entrepreneurs should strive to do. They want to be successful. They want to build their wealth. And I'm not talking about just the wealth in terms of, your balance sheet and your money, your personal wealth. It's, you want to increase your wealth as to the service to your clients, to your employees, to all that good stuff. And what net worth really boils down to, in my mind, net worth equals network. Again, net worth equals network. So think about it. It's who you know, not what you know. If you have a strong network, and we've seen that throughout this presentation today, where you've got a network of people at VBOC, Business Impact Northwest, you've got the people who know how to get things done. You have to know who they are and how to engage them and when to engage them. And you've got to know, like, and trust the people you're working with. So think about it. If you build that network over time of bankers, lawyers, CPAs, clients, customers, you build that strong network, I guarantee you your net worth will follow. and you can measure that any way you please because you're the small business owner and you determine success, nobody else.
Absolutely. Thank you so much for your service, Curt and Shawn, and thank you for sharing your experiences in small business with our military connected business owner community. But now we are actually going to give out a couple of prizes.
All right, we're giving away 4 prizes today. So the first one is going to be from Arcata Business Services. It's 5 hours of free tax or accounting services. And the winner of that prize is going to be Dan Luce. And then our second prize is going to be a bookkeeping and tax preparation course donated by Taxi Sign Lily Tran. And the winner of that is going to be Conrad Stowe. We're also giving away 2 Staples $50 gift cards. The first winner is Jay Sana and Stacy Gordon. So congratulations to Dan, Conrad, Jay, and Stacy. We will be in contact to get you your prizes.
Awesome. Now I would actually like to take a moment and highlight Michael Rice as the VBOT coach of the day. Michael comes from a military family. He has run his own businesses and has a great deal of experience consulting with other business owners to help them to be successful. Michael is a business advisor and Boots to Business instructor with Business Impact Northwest and the Veterans Business Outreach Center.
All right, so I'm back on. Well, I want to thank our sustaining partners, the SBA, the USDA, Harborstone Credit Union, BECU, Verity Credit Union, Sound Credit Union, and Washington State Employees Credit Union. Business Impact Northwest really appreciates all of your support. I would also like to thank Union Bank, our presenting sponsor, for Operation Entrepreneur. Your support helps us celebrate military-connected businesses this week. I also want to thank Roland and John for the great keynote, and Shawn and Curt for sharing your knowledge and experience with our fellow veterans. I also want to give some shout outs today, since this is our last day, to Kat Mason, Amber Bittner, Lexi Amstedt, Chris Armstrong and Goings from the VBOT team for their fantastic work emceeing and presenting this week. In addition, at Ben, I got a few more shout outs here. We have an amazing communications and marketing team, Greta Stowe, Morelli Woolley, and Oz Diaz, who worked very hard all year to put together a really cool graphics and to spread the word about our event through the marketing channels. That's how you all knew we were doing this week. They also helped coordinate getting those awesome prizes that we were able to give away this week as well. They kept me on track through the planning. And finally, thank you all in the audience for attending today's webcast on financing. Whether you're a veteran, military spouse, or just a supporter of military connected business owners, we appreciate your attendance today and this week. Please remember to check out our website at businessimpactnw.org for more information on our services and upcoming training and events. I look forward to seeing you around the VBOT block. Have a great rest of your week, everybody.